Hi, I'm Nick Boguth. Thank you for tuning in to our fourth quarter investment commentary. I invite you to read the written commentary as well, where you'll find some more details we may not get to here in the video. Think back to 1 year ago. We were coming off a great year for the stock market. Unemployment was historically low. Inflation was coming down. There was hope, but caution in the markets. Analysts were forecasting a modest year for the stock market, but maybe there'd be a recession or increased volatility from the election, so don't get your hopes up. Well, the year's over, and the S&P returned 25% in 2024. It blew right past everyone's expectations. The U.S. economy is in such good shape that the Fed may not cut rates as much as originally projected. It wasn't as incredible of a year for other asset classes. Bonds and international stocks lagged, but still had positive returns for the year. All in all, leading to a strong year for most diversified portfolios that included these asset classes. But the standout was definitely U.S. large cap, continuing their dominance throughout the last year. Now, on to expectations for next year. Here's our Director of Investments, Angela Palacios.
In December, the Federal Reserve concluded its final meeting of 2024, capping off a year characterized by notable disinflation and robust economic activity. However, looking ahead, uncertainty persists. The proposed tariff and immigration policies from the incoming administration are creating a murky outlook for both investors and the Fed in 2025. With the Federal Reserve still in an easing stance, equities are likely to remain well supported. As the saying goes, don't fight the Fed. Although the December rate cut was considered hawkish, indicating fewer future cuts, our focus remains on an overall economic trajectory which appears very resilient at present. Given the economy's ongoing momentum, earnings are expected to continue rising in 2025, bolstering our long-term positive outlook. In the short term, there can always be volatility caused by headlines we haven't yet thought of. So why doesn't the potential for increased volatility or a different political regime or potential tariffs worry us to the point we're making sweeping changes to your allocation? The answer is a strong consumer. Since consumers account for 70% of the U.S. economy, they are a crucial factor to monitor. The strength of the consumer in 2024 was evident through several key indicators. Consumer spending has shown consistent growth, and consumer confidence remains high, driven by low unemployment rates, steady job growth, and rising wages. There could be some signs of weakening in consumer spending. We're starting to see consumers trade down in their purchases, meaning they're still willing to spend but opt for cheaper goods and services. While there aren't many cracks to be concerned about yet, it's certainly an area we watch closely. Bonds have had an unusual year. As we entered 2024, we were still cautious. Consequently, that caution we've exercised in that segment of our portfolios has helped mitigate some bond volatility in 2024. Treasury yields have defied historical norms by rising instead of falling after the Fed began cutting rates in the fall. Stronger than expected economic data and slower than desired inflation declines have prompted investors to reassess the Fed's anticipated rate path. This suggests that yields may remain higher than initially expected. The Fed has largely achieved its goals regarding inflation and employment, even though markets might prefer more action.
Great update, Angie. Thank you. I mentioned analyst forecasts earlier. Every year, the largest institutions release their forecasts for the coming year. I linked to one article that compiled these for last year. They were lukewarm, ranging from a little bearish to a little bullish. And what happened? The stock market surpassed even the most bullish forecast before May of last year. There's a lot to take away from that single anecdote, but the lesson that this reiterates to me is that investing in stocks is risky and unpredictable in the short term, but remarkably consistent in the long term. So with the S&P 500 returning 26% in 2023 and 25% in 2024, does that mean we're due for a down year? Looking back on history, the answer is no. We're not due anything. The year or two of prior returns do not signal anything about next year's return. Please visit the blog section of our website in the coming weeks for a post that goes into more detail on that topic. Now, back to Angela for thoughts on the election and markets.
As the election dust settles, it is important to remember the economy is usually the guiding force behind winners and losers in our portfolio. Overall, rising corporate profits, continued economic expansion, and the potential for lower yields later this year provide a potentially positive backdrop for the markets in our view. Some areas like international investments may see additional headwinds from political forces like tariffs or a strong U.S. dollar. At the same time, smaller companies in the U.S. may see some natural tailwinds from continued onshoring and disinflation. While there are many reasons for an optimistic outlook, being prepared for a downturn is evergreen. Our actions in your portfolio will reflect our continued research and developments in these areas as President Trump takes office. There are important things that we need to focus on as always, such as making sure that you have 6 to 12 months of expenses set aside in cash so that we can weather any short-term volatility in markets, especially if you're retired. Rebalancing to maintain proper diversification and paying close attention to tax loss harvesting and capital gains. A new administration may provide new risks, but when aren't there risks in investing? With new risks also come new opportunities and innovation, and our investment committee meets monthly to ensure portfolios are allocated in a way to take advantage of markets that are constantly changing. If you have any questions, I'd love to hear from you. And as always, please reach out to any one of us at the center if you have any questions on your portfolio or overall financial plan. Thank you for joining us and Happy New Year.